I'm missing the rest of the family, but I'm ready to go. So let's get them and let's go. Hey everybody, Tom Gentile. Welcome to the weekend. If you're getting this, I'm in the van with the family. We're heading from Florida to New York. Mike Wade's filling in for me. Got a great video called Trading the Honey Badger Strategy. If you like it, show us some love. Hit that thumbs up button below. And if you're a subscriber, go ahead and notify us by hitting the bell. We will notify you every time we have a video upload.
I saw this funny meme the other day and I wanted to share it with you. When the prey is armed, predators think twice. But not the honey badger. The honey badger doesn't give a darn. The honey badger goes in and goes for the prize. This reminded me of a strategy that I really love that I think you're going to like as well. And I'm going to call it the honey badger trade. You've probably seen videos. There's a funny video online about how the honey badger just goes after cobras, gets bitten, falls asleep, gets up and finishes eating the cobra. This thing is relentless, it's unstoppable, and it reminds me of a strategy that I want to share with you, and I'm going to call it the honey badger trade. This is a high probability 24-hour earnings play. Yes, that's right, you get in and get out within 24 hours. Emphasis on the high probability. Now, one of the things about this trade is that you can get bitten, and we need to talk about that and make sure you really understand the pros and cons of this high probability strategy. So let's talk about the opportunity. What are we after? What's the food? Here's the food. It's implied volatility. The implied volatility is the expense of the options. Here's an example on stamps.com. Stock symbol is STMP. And notice these green E triangles. Those are earnings announcements. And what happens into earnings on Stamps and many other companies is that the implied volatility rushes into earnings. And then the very next day after earnings, and this is imminent, it will always happen, the IV will plummet the very next day. This pattern, where the IV spikes and then plummets the next day, is how we want to make money. And what we do is sell expensive options the day before the earnings announcement, and we get out the next day when they're cheaper. So there's this imminent IV crush, and that's how we make money. Sell expensive, buy them back when they're cheap the next day. Happens all the time on Stamps and many other stocks. You can see it happening here. Right at earnings, the IV was very expensive. And then immediately the next day, those expensive options were cheap the following morning. So that's the play. Now, what's the risk? What's the cobra bite? What do you have to contend with? Well, here's what you have to contend with. I have the same implied volatility chart overlaid with the stock chart. And you can see here that we have our expensive options right on this day, the day before the earnings announcement. And then what happens after the earnings announcement? Yes, the IV drops, and that's good for us. But it's not good for us because the stock actually gaps up, leaving us at maximum risk. So that's the cobra bite. You've got to be prepared to survive that. And I'm going to show you exactly how you can be like the honey badger and survive a gap in the stock. Now, Stamps doesn't always gap, and you can see here, we sold expensive options right before earnings, and then the next day, the IV tanks, but the stock goes nowhere, and we make maximum profit on that trade. So really, the system is about selling expensive options and finding stocks that don't gap very much at earnings and staying safe. So the next question you should be asking yourself is, what kind of trade am I using to capture IV crush and profit provided the stock doesn't gap? That trade is called an Iron Condor. In my last video, I talked about butterflies. An Iron Condor is like a butterfly, but it's much wider than a butterfly, as the wings of the condor here imply. So here's an Iron Condor, an example of an Iron Condor construction. Similar to a butterfly, it's constructed with a bearish and a bullish trade in the same trade. So right here, what we're doing is we're selling a 280 put, and we're buying a 277.5 put. That is a bull put spread. That's a bullish trade that makes money above 280. And then we have a bearish trade. We're selling the lower strike 307.5 call, and we're buying the higher strike at 310. That's a bearish trade, a bear call spread that makes money anywhere below 307.5. So as long as the stock is between these two short strikes, we're going to make some kind of money on this trade. So that's the idea. In this example, we ended up taking a $100 credit with risk of $150 for a potential one-day profit of 66.67%. That's in a day, ladies and gentlemen, and that's the power of the honey badger trade. Go in, get your meal, and leave, and be prepared to take a cobra strike. So let's go right into an example. Here's a 24 Iron Condor on Apple computer. Here's the food in the trade. This was the day before the earnings announcement, and notice how expensive the options were on Apple in the last trading moment before the earnings announcement. And what we're going to do is we're going to come in and feast on that implied volatility and eat it, make money as the IV crushes imminently the next day after the earnings announcement. So here's our potential cobra bite, which is gap risk. What we need the stock to do is stay between the break-evens. I'll show you the risk graph in a minute. Notice here at the last earnings announcement, there was a slight gap, not a big gap, just a little bit of a gap. Not a big deal, provided your break-evens are wide enough. So we need a risk graph to help us really assess the probability of that. So let's build an Iron Condor on Apple. So here's what we did. We sold a call credit spread at 307, meaning that we sold the May 1 307.5 calls, and then we bought the next higher strike call, which was 310. That's a credit spread that makes money below 307.5. And then we sold the May 280 put and bought the underlying 277.5 put. That's a bull put spread. That makes money above 280. The net credit on both those two credit spreads was $1 with $1.50 risk. Times 100 shares is $100 of entry credit. That's our maximum profit. And then our maximum risk is the $1.50 times 100, which is $150 of maximum risk. That gives us the opportunity to make 66.67%, provided the stock stays between these two break-evens at 279 and 308.50. A picture paints 1,000 words. Let's take a look at the risk graph on this Apple Iron Condor. And similar to a butterfly, we have a profit zone. That's the green zone. And as long as the stock the next day stays between 308.5 and 279, we're going to be at something close to maximum profit. Note here that there's only 1 day left in the trade. These options actually also expire the next day right after earnings. So let's see what happened. The earnings came out, and the very next day, this is what happened. Apple didn't move very much. It kind of moved around quite a bit, actually. Had the high here and the close right here, basically where it started, and the whole spread expired worthless. This was a net 66.67 profit in 24 hours. So how do you handle the exit on these things? I'll show you the actual exit rules, but if you feel confident the stock is going to lie between the short strikes, which is there and there, then let the whole thing expire worthless and collect maximum profit without having to pay any commissions. All right, so let's talk about surviving a cobra bite with proper money management. So you're going to get stung on these things. You're going to get bitten. You're going to be at max loss on some of these things sometimes. So it's important that you know how to survive the cobra bite just like the honey badger does. And we're going to do that by practicing proper money management. We're going to reduce our risk to the point where we can take the bite and survive for another day. So let's take a look at that. First off, let's calculate the Iron Condor maximum risk. The maximum risk of an Iron Condor is to take the distance between any one of your credit spread strikes and subtract the credit, and that is your maximum risk. So let's take a look at the Iron Condor for Hershey's. This is an example. So right here we have $1 distance between the calls, and down below we have $1 distance between the puts as well. You want to make sure those distances are the same for each credit spread. Now if I take the distance between those two, that's $1, and my entry credit is 35 cents. So that would yield a 65-cent maximum risk in the trade. And notice there that that's reflected. 65 cents times 100 is $65 of maximum risk. So that's how you calculate the maximum risk in a credit spread. And we want to make sure that we position size our Iron Condor, 3 in this case, such that my maximum risk is at or beneath my maximum position size threshold. So for example, in this case, if my maximum position size was $200, then I would have positioned this appropriately. So what does that mean? That means if you take a massive hit, the stock moves big, the biggest loss that you'll take is $195 and should be in the neighborhood of 2 to 3% of your entire account. That's not a big deal. Take the loss, get up, and go after another one. So let's take a look and see what this one did. This was a 1 day Iron Condor on Hershey's, and a beautiful Iron Condor, very wide, Over the last earnings period, the stock did gap a little bit, but historically this gap here is going to be contained by the break-evens here in the event that it happens again. So this was actually a really good looking setup. Here's our profit zone. Again, if the stock stays in this backyard, this green zone, after the earnings announcement, then all of these colored lines go to zero or close to zero, and we make money in 24 hours. So here's what actually happened. The stock gapped up after earnings, gapped more than it normally does. The dog jumped the fence, the cobra bit us. We take this off for a loss. In this case, because we had an extra day of time left in the position, we were able to take this off for only a $105 loss, even less than the $195 maximum risk. So that's how you survive the cobra bite. Make sure you position size your condors such that if you do have to take maximum loss, then it's not that big of a deal in your overall account. Very, very critical that you do that. How do you exit an Iron Condor? Well, you flip the battery in backwards, meaning you sell what you bought and you buy what you sold. So in this case, notice we bought a 145 call and we bought a 132 put. So we're going to sell those two options. And then, of course, the options that we sold, which are the 144 call and the 133 put, we buy those back. We do that as a spread order, as a package, and we shut down our Iron Condor that way. Very simple. So here are the rules for 24-hour Iron Condors. You want to sell a bear call spread, use consecutive strikes. Do the same for your bull put spread down beneath. Use the first expiration after the earnings date. If you use weekly options, that might be just a couple of days. That's ideal. Separate the short strikes as wide as possible. How far apart? That's a good question. Number 5 answers that. Make sure your credit is at least 50% of your risk, which would mean it would give you a possibility of making a 50% return on investment overnight. And there's plenty that offer more than that, but make them as wide as possible. Give yourself around a 50% return on investment. Enter the day before the earnings announcement and then exit after the earnings announcement. Hope you enjoyed the video, and I'll see you next time.